In order to do that, I'm just going to present this framework. And ultimately, total returns can be broken down into two key building blocks. One is that price or valuation I've talked to, and the second is earnings or fundamentals. Now, there's huge amounts of empirical evidence that will show you that the longer term you invest, the more important the fundamentals become as a component of your total return. So over a 10-year period, between 80 and 110% of your total return could be explained by fundamentals. And even over a 5-year period, it could be between 70 and 80%. And so that's not to say that valuation isn't important. Valuation obviously dominates the short term and contributes to the long term. The point is that for us to be able to deliver good total returns to our clients and your clients, we really need to be getting those big fundamental bets right. And so the chart on the left-hand side here shows you that our lived experience in the past 5.5 years does align to that empirical evidence. So if you look at the left-hand side of the chart, it's breaking down those total returns into valuation and fundamentals. So as you can see, over 5.5 years, the vast majority of that 20% annualized total return has been explained by the fundamentals and the compounding up. And those fundamentals have grown at around 15% per annum versus the MSCI World, which is giving you 10%. Now think about that 10% because typically MSCI World actually delivers you about 6 to 7% earnings growth and a little bit of dividend. So it's a little bit higher than normal, and that's because we've been at a cyclical peak. We haven't yet seen the earnings downturn, but also we've seen the energy earnings, which are up 5-fold from almost nowhere. So I'm not sure if necessarily that 10% is repeatable or sustainable for a long period of time, but nonetheless, I guess we would at least stand behind that 500 basis points of what we would call sort of structural alpha. That's the fundamental spread that we're continuing to try and harvest every year. The reason why this chart's also quite useful is explaining the past 2 years. Now, there's no getting away from the fact that valuations have had a major impact on markets. So if you'd looked at this chart towards the back end of last year, our total annualized returns from our portfolio were about 30% or just over. And with over 10%, nearly 15% contribution from valuation. And that's all come crunching back in. Same with the MSCI World. 1 point post-COVID is about a plus 700 or 800 basis point contribution from valuation. Now it's showing you minus 1%. So you've seen this big valuation compression. That's what's happened. That's told you the story through the past 2 years and why total returns in equities have fallen quite sharply. Now looking to the earnings resilience phase, which I think is where we're going to increasingly focus our attention. And this chart on the right-hand side shows you that fundamental building block, or earnings, expressed as a time series. And the gap there, which is the 15% compounding up versus the 10%, obviously will grow over time. But really, it's the stability and resilience of the earnings that are in focus here. And if you look at that red shaded area, that was the initial onset of the COVID period, when, of course, if you remember, the world literally stopped. We were in an earning contractionary phase. And during then, the portfolio earnings were revised down by analyst estimates for our portfolio by 11% and 22% for the MSCI World. So ultimately, that's the framework of the philosophy and this fundamental approach in action. 50% higher rates of compounding up of fundamentals for 50% lower drawdown in those fundamentals. Now, I want to play devil's advocate because actually, whilst there are problems being an active stock picker with just overall allocations to these buckets, and I've talked about some of the issues that you can get within value, it's the same with growth. And I think the past 2 years and the bond yield volatility has really lifted the hood on what it is even growth managers have in their portfolios. And the truth is that growth does not create value. Growth can also destroy value. And the point is that you need two things. You need an economic profit base, and then you need economic profit expansion. So it's not going to have one without the other. And as we've seen, I think it was mentioned in the previous session, there's been a lot of hyper-growth companies that effectively went up, in the case of, say, Peloton, 8 times and then fell 90%. Because for a lot of those companies, there wasn't the economic profit base. So we don't invest in the hyper-growth kind of companies. And I think it's really been a reality check for actually just thinking about key fundamentals again, and rather than getting wrapped up in thematics and all that kind of stuff, which is just another code word for growth. Growth is just one key component of delivering returns. So this bond yield volatility, which caused a lot of that valuation or exposed a lot of those multitude of sins, if you look at the long-term bond yield, so this is 10 years because ultimately equities are a long-term asset class, so it's kind of a proxy for long-term discount rate. And we went from a pre-COVID peak of 3.3%, and we crashed all the way down to 0.5%. Now, one perspective you can take is you can express yields just like a multiple, because it's just 1 over the yield as a multiple. So it's a bit like saying that bond yields went from a PE of 30 times to 200 times. So obviously in hindsight and on reflection, it's no surprise that all asset classes, given opportunity costed capital, got re-rated as well. So equities here, S&P 500 went from 18 times to 28 times, housing, growth stocks, and everything. So one thing though I would say is that we've seen, if you look at this chart, that red period, we've seen some normalization. So I'm not trying to call a bottom by any means, but clearly a lot of that valuation excess has unwound.
Yeah, I think clearly our view is that valuations haven't fallen enough. The issue that we have is mainly with the US market still trading in excess of 17 times next year's earnings. And so on the P ratio, we also think the E is overstated. So we're not going to get 7% EPS growth in the US. So the P ratio has to come down, but the E factor has to come down as well. So that's double negative for us. And so unfortunately, the march of market is such that the price will adjust first. Analyst revisions will come second. So that's why you have to position ahead of that, because again, revisions will come later.
So just specifically on that, we've obviously had a reasonably strong earnings season. You know, how are you positioned currently, and what would you see as changing in your portfolios to deal with that?
Well, we've been quite notoriously defensive for a while. We believe we are in this situation where we had such strong tailwinds from a macro standpoint coming into this year that would take an enormous amount of tightening to really constrain monetary conditions to the point where it's hurtful, not only to the economy as a whole, but really to the unemployment side of things, which is usually the last thing that breaks. Right? So we are at a time when the very leading indicators are starting to roll over, but the lagging ones, i.e. companies' earnings on a 12-month basis, looking back, and employment are still quite strong, right? And we think that looking at past data is not going to help us, right? And if anything, the fact that the data is coming in quite strong gives plenty of room for the Fed to be more aggressive and actually dampens the economic activity even more than we think.
So you mentioned value growth, which is a sort of a very well debated and discussed, anomaly in markets, and about how we're rotating between one and the other. Is that the right way to look at portfolios at the moment? I mean, growth is a very broad church. It's in everything from ARC, highly speculative growth, all the way through to sort of probably the more quality growth of a Fiera. Is that the right way to think about it, or should we be thinking about things differently to that?
The way we've thought about it is, you have, if you're considering that ARC, that go-go growth versus the quality growth, or probably if you have in a scenario like the 70s, you don't want to be in an ARC. So it's understanding that level. But value versus growth, our viewpoint has always been we want a neutrality between the both. And you can tilt between, and again, in managed accounts, you have the ability to probably tilt between one style versus the other, depending on maybe shorter term economic environments, not as an alpha generator, but as a risk control measure, more than anything, and understanding the process of the underlying manager and what they're trying to achieve. So really our approach has been, maybe we're not choosing one versus the other because no one has the magic answer of what's going to happen going forward. I think that's the other aspect.
Does it make you at the margins sort of, pull away from the extremities of style?
Yes. In short, yes. But then you sort of need the different styles within a portfolio. You need to have both extremes, I think. And it's how much volatility in general you're willing to take, so how you're blending those extremes with other styles in your portfolio or asset allocation within that space.